Hi everyone, welcome back to the channel. As of now, we have covered question number 1 to 5 of valuation advanced series. There were only 14 questions in the series, and these are big questions. So these questions actually involve a lot of explanation and looking into detail. So that's why it's taking a lot of time. I hope you guys are okay with it. I just want that we do not miss anything, any topic. So that's why I'm making smaller. I'm trying to cover less question in one video. So let's start with question number 6. So question number 6 is about both merger and premium analysis. So both merger and acquisition premium analysis and precedent transaction involve looking at previous merger and acquisition transactions. So previously we have discussed how do we calculate merger and acquisition premium analysis and precedent analysis. We are aware about this. So in basic questions also we have covered precedent transactions. So, so both of these involves looking at previous M&A transactions. And so here in the question it's asking about how and what is the difference and how we select them. So let's break it down carefully. And first, let's understand about, let's revisit merger and acquisition premium analysis and precedent transaction analysis. So precedent, if we talk about precedent transactions, so the goal here is to value the company by looking at how similar companies were priced in past merger and acquisition deals. You examine the actual transaction multiples paid, like enterprise value to EBITDA or enterprise value to revenue, to understand what acquirers were willing to pay for comparable companies. And in merger and acquisition premium analysis, here the focus is on the premium paid to shareholders over the trading price of the target company and at the time of deal announcement. So this analysis helps gauge what kind of control premium buyers typically pay in similar situation. And the selection criteria for precedent transactions is usually fewer deals are used because the goal is to find the deals that are truly comparable. And screening is restricted. Oh, sorry, screening is actually stricter here. So stricter means that industry must be similar, financials must be similar sized, and profitability also matches. Geography wise, often matches the target region and timing also. So typically within 5 to 10 years to reflect current market conditions, we look at the screening, the timings, so that we can compare the screening along in the industry. And merger and acquisition premium analysis. So this can include more deals, sometimes dozens, because the analysis looks at broader trends of premium rather than the exact valuation multiples. So seller, um, the the second selection criteria in merger and acquisition premium analysis, that the seller must be public because you need market stock price to calculate the premium, and that's pretty much obvious. And industry and financial screenings are less stringent. Means that the key is the relevance of the type of the transaction rather than exact comparability. So these were the selection criteria for precedent transaction and merger and acquisition. So afterwards, the data, if you look at that from the data's perspective, so precedent transaction analysis, uh, it focuses on deal value and multiples of enterprise value, EBITDA, and revenue. And deals can be public or private as long as transaction information is available. But in merger and acquisition premium analysis, it focuses on market price and premiums. So premium paid over the target's share price, 1 day, 20 day, 60 day before the announcement. So this one is actually a little trickier. the merger and acquisition premium analysis. And only public targets are used because private company stocks are not observable. So so private companies do not have an obligation to report out their data. They do to their shareholders or investors, but they have no obligation to report the data to the general public. To government, yes, they can do. Private companies, but and to their shareholders, but not to general public. And that's very obvious because confidentiality. Private companies do believe in maintaining confidentiality. And there are a lot of benefits in maintaining confidentiality the when you think about it from a business perspective. So basically, if we think about it, key difference here is that the purpose are uh, both of these have different purposes. One is you are doing valuation using past transaction multiples, and you are actually here in merger and acquisition premium analysis. You are actually evaluating premiums paid to shareholders. If you think it from the perspective of deals, so here they are usually usually fewer deals, and here I mean, there are often more and broader trends when we think about the number of deals. Here the sellers are actually public or private, but here the seller must be only public. Here the screening is more stringent, industry size and region, and here the screening is less stringent. So the key difference between merger and acquisition premium analysis and precedent transaction lies primarily in how we select the deals. For merger and acquisition premiums, we are typically looking at the broader set of transactions because the goal is to understand the premium paid to the shareholders in comparable deals. And one important distinction is that all sellers in the premium analysis must be public companies. So since we need a reliable market price data to calculate the premium. And in contrast, the precedent transaction analysis often involves fewer deals. So usually fewer than 10 because we are focused on transactions that are truly comparable in terms of size, industry, geography, and financial profile. With merger and acquisition premiums, we can cast a slightly wider net and might look at dozens of transactions since the screening criteria for the industry or financials are generally less stringent. So while the screening for both analysis is similar, considering factors like industry, geography, and financials and timing, the scope and the requirement for public data are what mainly differentiate the two. So the factors like we have discussed about the factors, the selection criteria, then we look at the timings. Timing is always important, and previously we have discussed if it's a booming economy or it's a downturn in the economy. So that will affect our valuation always. So if you are new to valuations and this much you understand that if you understand the timing concept, then when you will be working on a actual live basis, when you will be working live basis on a company, then you will first understand the economy. Then you will understand the market, and then only you will be able to collect data because you understand what data is required for that. So then only you will be able to take relevant data. And this is how industry, geography, financial actually, even though we are only discussing question and answers, but if you think about it, if you put your brain to work, then it will actually give you a lot of perspective now. You will start creating opinions and uh, you will get a direction where you actually want to look. So the bottom line is that the both analysis here in this question, both analysis rely on past transactions, but precedent transaction is about specific deal comparables and valuation multiples, while merger and acquisition premium focus on historical premiums paid to public shareholders, allowing for a broader set of data. The stricter selection in precedent ensures comparability, whereas premium analysis prioritizes observable market trends. I hope this is clear. So let's move to question number seven now. So this question number seven is about uh, some of the paths, some of the paths valuation. And in some of the paths valuation, uh, let's break it down step by step. Uh, some of the parts, some of SOTP analysis in detail. Uh, the first question would be, so what is sum of the parts analysis? So sum of the parts analysis is actually is a valuation method used when a company has multiple business segments or divisions that operate in different industries. So then only we will use some of the parts analysis. The idea is that each division may have different growth prospects, profit margins, and risk profiles. So valuing the company as a single entity using one multiple can be misleading actually. So instead, what we do in some of the parts value analysis is we value each division independently. We add up the individual values to get the total enterprise value, and then we make adjustments of net debt, cash, and minority interest to get equity value. So some of the parts is especially common for conglomerates, diversified holding companies, and companies with both high growth and mature divisions. So that's some of the parts. But if we think about the steps that should be involved in some of the parts, is first we will first identify the segment. I mean, identifying all the division of the business units that are materially different in terms of industry growth and margins. For example, if there is a conglomerate which is diversified into manufacturing, entertainment, and consumer goods. So each division is treated as a standalone business for valuation purpose in this some of the parts. So here we have an example also. We will discuss it um, in a moment. And after we have identified the segment, then we will choose an appropriate valuation method. So for different segments, the basic for each division, the selection valuation method that best reflect market value, we will choose that. And previously we have discussed about comparable companies, precedent transaction, and discounted cash flow. So we can choose any one of those. And actually the key here is to pick a method that reflects the segment's industry norm. So if manufacturing segment, the industry norm is comparable trading comps or precedent transaction, then we will use that method to value that specific segment. And then we will calculate the division values. So this you actually need to understand step by step. So how we are going to then, and at the end of the time, uh, at the end of the valuation, we will add all the valuation of different segments. Then we will generate the enterprise value. Then we will adjust for non-operating items in the enterprise value. And that will give us the equity value of the company. Previously, we have discussed about the enterprise value and the equity value concept. And I hope this will not be a problem to generate to calculate enterprise value and equity value after. Uh, I mean, this is the 14th lecture. So after 13 lecture, I don't think that this should be an issue. And so why actually yes, some of the past value is useful because see the different divisions may deserve very different multiples. Like for high growth entertainment division might be valued at 8 times or 10 times X of EBITDA, while low growth manufacturing divisions trade for like should maybe 3 times of EBITDA or 5 times of EBITDA. Some of the parts valuation actually provides a more granular view of company's intrinsic value, a little more detailed, and it actually helps investors and buyers to identify undervalued segments or hidden value in conglomerates. And the key consideration, if you talk about it, and the key limitations is that the data availability. So data, you need enough comparable companies for transactions or transactions for each segment. You actually data is going to be a key consideration or limitation here in some of the parts. So data is always give a priority to good quality data and interdependencies also. So here, if you are working on the sum of the parts analysis, you need to understand that there can be interdependencies between divisions. So maybe some divisions share cost or revenue, which must be considered in when you are doing some of the past analysis. And one-time items like EBITDA, which is normalized for each division, and you need to make sure that EBITDA is normalized for each division. And along with that, market sentiments. So some of the parts is highly sensitive to the multiples chosen for each segment. So you need, when you are doing the sum of the parts value, you need to consider all these points, which we have discussed here. So let's talk about this example. So we would calculate, we here is the example. The imagine a company has three divisions: manufacturing, entertainment, and consumer goods. Suppose manufacturing division generates 100 million of EBITDA. So manufacturing is generating 100 millions of EBITDA, and entertainment division 50 millions of EBITDA, and consumer goods is generating 75 millions of EBITDA. After analyzing relevant comparables and transactions for each segment, we determine that manufacturing trades at 5x of EBITDA, entertainment at 8x of EBITDA, and consumer goods at 4 times of EBITDA. So we would then calculate the implied value of each division. So we are generating an implied value which is 100x, 100 times into 5, 500 million, entertainment at 8x of EBITDA, 400 million, and consumer at 4 times of EBITDA at 300 million. So we will add these all and we will generate an enterprise value of 1.2 billion for the company. And then uh, we will actually have to adjust this um, the enterprise value for the non-operating items. So non-operating items, finally, in the context, we might adjust this for net debt or controlling interests to arrive at an equity value. So some of the parts method is particularly useful for conglomerates or diversified companies because it allows each business segment to be valued according to its own economies rather than applying one size fits all multiple. So this was actually a very simple example, but in practical life, you need to understand. You need to just grasp the concept here, the sum of the parts value analysis. But when you will be doing a SOTP, sum of the parts analysis, it will require a lot of deep thinking, and uh, you will be needing very good quality data to do a sum of the parts analysis. All your estimates and forecasts or growth numbers should be relevant because I'm not pretty sure what if you have ever experienced that. Even if you post anything on LinkedIn, then people will ask questions, and you should have all the answers to those. So you need to run every scenario inside your mind first. What I mean to say is your analysis should be that much detailed. So like they say, the devil lies in the detail. You actually should be that much detailed and confident about your valuation. So I think that's all about some of the parts analysis. Let's move to question number 8 without wasting any time. So when we will do I mean, there are a lot of lots of type of valuations, and we will do one by one. So before we start evaluation, what I am planning is, um, we will discuss sessions about industries. So different industries and sub-industries and sectors before starting with the valuation. So that's required for you to understand the sectors and what the KPIs are, what are the price and the cost drivers of a company, of a sector. So we will do everything. And let's move to question number 8 now. So question number 8 is talking about how do you value net operating losses and take them into account in valuation. So net operating losses are valuable because they reduce the company's taxable income in future years, which translates into tax saving. We know that, we are already aware about this. So when valuing a company, the goal is to quantify its benefit and incorporate it in overall valuation. So this will be giving us a benefit, right? So the first step is to estimate the tax saving that the NOL will generate. So first we will do is, so this, if we are to value the net operating loss, we will first estimate the tax saving that the net operating loss will generate. And this is done by projecting the company's taxable income over a number of years and applying to the NOL to offset it. Um, then the tax saving in each years are calculated as the annual applied multiples by the corporate tax. And once you have the projected tax saving, you discount them back to the present value using the appropriate discount rate. And usually, company's cost of equity or after tax cost of debt depends on the context. So there are actually two major approaches. One approach is okay. So one approach is actually full utilization assumption, and another approach is acquisition or usage limited scenario. So if we talk about full utilization assumption, uh, in full utilization assumption, we assume that the company can use its net operating loss to completely offset taxable income each year until the net operating losses are fully utilized. And this is a straightforward, but works best for companies expected to generate sufficient taxable income in the near future. So company can fully use its, and so this one is what I'm talking about. So this is full utilization assumption. We are assuming that we will fully utilize our net operating loss. And the second one is acquisition or usage limited scenario, acquisition scenario. So here in this scenario, in merger and acquisition scenarios, tax rules often limit the amount of net operating losses that can be used in any given year. So a typical approach is to calculate the maximum allowable net operating loss utilization based on the adjusted long-term rate multiplied by the equity purchase price of the target. So you then apply that limit when determining the annual tax rate saving. So it's important to note that here that while net operating loss provides value, they are rarely added directly as a line item in valuations. Uh, so if you were to include them explicitly, they would act similar to cash. You could adjust from equity value to enterprise value by subtracting net operating loss or add them back when going in other direction. So essentially, the main impact of net operating losses through effect on after-tax cash flow rather than as a standalone asset. And in summary, if you talk about it, valuing net operating loss is about estimating the future tax saving they generate and applying any usage and limitation and discounting those savings to present value. This ensures that the benefit of net operating loss is captured accurately in overall valuation. And so basically, net operating loss will act the same way we treat cash, is the same way we'll treat the net operating loss. But under different scenarios, with under different approaches, the treatment is different. Full utilization, if we are to fully utilize it, or if you are to in acquisition or usage limited scenario, so there are different treatments. So that's been said. Let's move to question number 9. I hope this question net operating loss is clear. Um, So if the interviewer is asking, um, the question is designed this way that the question, I have a set of public company comparables and I need to get the projections from equity research. How do I select which reports to use? Okay, so when selecting equity reports, together projection for public company comparables. The goal is to actually obtain the reliable, objective, and useful data for your valuation. So there are a couple of common approaches that analysts use. Uh, First approach would be selecting the report with the most detailed information, because some reports provide more granularity, more detail than others, including segment level revenue, detailed expenses assumptions, or multi-year forecast. And choosing the most detailed report allow you to understand the underlying assumption and build a more robust projection in your model. This approach is particularly helpful when you want to perform a deeper sensitivity analysis or reconcile differences between companies. And the second one would be the second approach is using the midpoint of available projection. So that's consensus. That means consensus of data. Uh, so another method is to aggregate multiple analyst forecast and take a central value, such as the median or midpoint. Uh, Consensus means everyone agrees onto that. That's consensus data, and there are different companies like if you have, I'm not sure if you have heard of Visible Alpha. It was acquired by S&P. So as Visible Alpha used to provide data based on consensus, and there are other companies also which do the same thing. And the, this actually helps you mitigate the bias from any single analyst who may be overly optimistic or conservative. By taking the middle ground, your model reflects a balanced view of market expectations rather than being skewed by an extreme forecast. So consensus means the basic definition of consensus means that everyone agrees onto that. So some if there is a range, different ranges. So think about it from football field, the diagram which we discussed about the football field. So in football field also, so we try to find out the common ground in between all the valuations, and so does the approach where the midpoint, using the midpoint of the project available projections, which is consensus based. And the key considerations when you are selecting reports is that you should not choose reports solely based on the bank or firms producing them. So for instance, if you are at Goldman Sachs, using only Goldman research would create a conflict of interest and potentially compromise the objectivity. So if you are valuing a company, you should not be biased in any way. So think about this. Uh, Biases, we will discuss about biases, and biases is actually a huge psychological drawdown when you are doing evaluation. So, and choosing reports solely, if you are choosing only one report, so this actually leverages a diverse set of perspectives. So the aim is to actually leverage a diverse set of prospects. So not only Goldman Sachs, you can go to HSBC also. You can talk about Lazard. There are different. There are different equity research publishers. Jeffries is there. JP Morgan is there. So all the investment banks are there which publish their reports. So uh, and another key consideration that we should keep in mind is make sure that data is current and relevant to your valuation period. So and some reports may lag in updating projections, which could distort your model also. So do rely on reports, do rely on all the other literature available, but you make sure that data is the current and relevant to your valuation period also. So, and cross-check for consistency. If one report assumptions are or growth rates are dramatically different from the rest, investigate why before including them. So, if the sources of data you are fetching from then the sources from you are fetching your data, or you are uh, starting your research from, you need to read something so before you start your research, you need to read about the company, you need to do your due diligence. So when you are doing this, consider if there are any question, then do dig into those questions. uh, so the overall process is about balancing depth of information, objectivity, and consistency here. And using these approaches actually ensures your valuation is unbiased and aligned with market expectations, and also defensible, so that like previously I told you that you should have all the answers to questions which might come. So you have to defend your analysis and valuation also. So let's move to question number 10 now. And after this, I will make one more video for valuation, advanced questions, because these questions actually require a lot of discussion and in-depth analysis. So I'm making lesser questions in one video. So question number 10. I have a set of precedent transactions, but I am missing the information like EBITDA for a lot of companies. So how can I find it if it's not available via public sources? Okay, so uh, if I were to encounter information like EBITDA in a set of precedent transaction, I would take a structured multi-step approach to fill in the gaps if I were a candidate there. So first, I would start with publicly available resources, and yes, this is a good option also. So I'd look for press releases, investor presentation, and financial news articles around the time of transaction, and those data can be assessed on the company's investor relation portals. So if you have not, so what I want you to do is just select a company of your interest, not Apple, because it's very not Apple, not Tesla, but because these are very famous companies. Let's do something else. Uh, a company of your interest, other than the famous ones, uh, and then go to their investor relation page at least. There you will get all the investor presentations and financial news articles written by the published by the company. And sometimes companies disclose financial metrics in their announcements, like media coverages or filings, even if they are private. So carefully search that could yield numbers. And second, if public sources don't provide information, you could consult an equity research report focused on the buyer or on comparable companies in the same industry. And for that, you can go to uh, if you have, I mean, if you have any access to FactSet or Capital IQ or any of the RMS Bloomberg, like Bloomberg uh, data set, then it will be a plus point for you. But if you don't, then you can Google them. Uh, any equity research, current equity research report, or recent equity research report published. These equity research reports are actually, and most of the times, these are paid research reports. So you actually have to pay. But so whatsoever is the whatsoever are the free available resources, just go through those and you will get a direction or a sense of direction where you actually have to dig deep. Uh, and after that, so analysts actually those equity research analysts often provide estimates for sellers' financials, especially if it's a significant transaction, and these estimates can be very useful proxy. And third, I would, if I were you, then I would turn to databases like Capital IQ, FactSet, or PitchBook. And these platforms sometimes do report out the equity research reports. And finally, none of the sources yield a concrete numbers. Then I will consider deriving an estimate using comparable companies or transaction multiples. So if you are if someone is missing information like EBITDA from a company, then you can reach out. You can calculate back the EBITDA using the peer companies analysis. So there are a lot of ways. If there is a if estimation involved, or if the transaction value of an implied multiple is known, then you can calculate back EBITDA, and through this process, you can document the sources and assumptions for each estimate to ensure transparency and credibility. And so the overall goal is to triangulate information from multiple resources rather than relying on a single and potentially unreliable figures, so that the analysis remains robust and defensible actually. So that's pretty much it. Even if you have done your evaluation and you are missing information, important information, then you can uh, reverse engineer those numbers. You can get those numbers back. Uh, I hope this does make sense, and we will discuss about these or everything when we will do real-time valuation. Don't worry about it. Just understand the basics first, the questions, and those are the explanations with the questions. This will help you to you will get a perspective about the valuation. So how the valuation is, what are the questions involved, and actually questions are used to test your concepts, and you cannot keep on brushing up on your concepts. So what you can do is you can answer or you can answer questions. Yes, you can practice questions, and practicing question actually tests your concepts, and that's the best way to retain information. So I will see you guys in next video, and until then, take care. If you have learned something of value today, subscribe to my channel. Thank you.